Shares versus property. The financial media loves to pit them against each other, but we're here to say that they can both play a part in your investing journey. Here's how. Welcome to Get Started Investing, a show where we help you make the most of your money. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going?
I'm very good, Bryce. Very excited for this episode. We are busting the myth that you have to choose.
Yes.
Financial media loves to have a dichotomy. Growth v value, property v shares. They love to pit two things against each other because I guess it gets the juices flowing.
Yeah.
It gets the clicks coming.
Yeah.
It gets the comments riled up.
Yeah.
So much in financial media is pitched as a debate. And I think for the first few years that we did this podcast, we kind of thought that we needed to figure out who was right. What's the right way to invest? What's the right way to make money? What's the right asset class to invest in? And what we've learned over the journey is that there are so many ways to make money as investors.
Yeah.
There's no one right way. The right way to invest for you is a way that suits your temperament, your risk appetite, your goals, your time horizon, all of that stuff. But for most people in most situations, the right way to invest is to do a bit of everything.
And that's what we're here to talk about
That's
today.
what we're here to talk about. Yeah.
So we're going to talk about how property and shares can be part of your investing journey. Now, for context, this was the thematic for our live shows, which were awesome, I should say. Thank you for everyone that came.
If he may say so himself.
If I may say so myself. So we thought we'd share what we spoke about on the live shows here on the podcast. We have released the show in its full extent on Equity Mates Investing. That will be live in the feed now if you want to go and search that.
Yes. So Bryce, we're here to reframe the debate. It's not one or the other. It's not if, it's when in our mind. I think if you get the conversation around property and stocks right, it can be a real situation where 1 + 1 can equal 3. So we want to talk about how we think about the sequencing and how you can maximize the features or the benefits of each asset class. And for us, when you're starting, it makes sense to start with shares.
Yeah, that's generally because when you're starting early as an investor, you won't actually have heaps to invest in.
Yes.
When we were at uni, we weren't rolling around with 100 grand in the bank account. We were personally barely scraping through. And so starting with small amounts of money is where shares come into play.
Yeah, it's not even just like if you're young and if you're at uni, however old you are, you can still benefit from investing. So if you've established yourself in your career, you're earning a good salary, but you're still just getting started, it still makes sense to start with shares because you don't have a lot of money in your portfolio.
Yes,
Yeah.
yes. So some of the reasons for shares being such a good entry point when you don't have a lot, there's obviously low barriers to entry. You don't need a whole bunch of money to get started. In fact, you can get started with as little as $1 on on some of the online brokers these days. Liquidity and flexibility. You're not stuck in one large asset. You can change as your temperament changes or as your ideas about investing changes. You can access the money quickly.
Yep.
You're not putting it all into a huge investment. So that is another reason. Diversification is another one. You can get easy exposure to geographies, industries, you name it. You're not just putting all of your money into a wildly expensive 1-bedroom studio in Darlinghurst in Sydney.
Exactly. You're not making the most leveraged bet of your life on one asset.
Yeah.
Yeah.
The one that I love, Ren, is that you're learning by doing. You can get in and build habits early, and you can do it without feeling like you're going to lose all of your money. And also, shares have incredible long-term historical returns. They've outperformed property over a long period of time. That is why financial media needs to flip the script and start talking when property goes up. Talk about when shares go up just as much.
Yeah. Well, if you're watching on YouTube, we'll include a chart that shows just how much shares have outpaced property. Now, okay, hold on. We're not here to say one or the other, but I think that conversation does often get lost.
Yeah, absolutely.
Like, the power of property is really around leverage. And we will get to that because that's when property starts to become part of the conversation. But I think, if you're feeling like you're missing out because you're not in property and you feel like you're being left behind, that story of the historical returns of shares is an important reminder that you're not missing out.
Yeah.
So we say start with shares, start building your wealth, start understanding how markets work, start making your money work as hard as you do.
Yeah.
At some point, you should start thinking about property. Now, as much as we would love to say you can just invest in shares for your whole life and rent for your whole life, it is important to note that at least at this point, every retirement planner seems to have an assumption that you have a fully paid off primary place of residence.
Yeah.
I think that will change. I think this
Absolutely.
generation
It is
of
changing.
generation of retirees are retiring with mortgages or as renters, and so assumptions need to change. But if you think about how retirement planning, how superannuation planners think, and the amount of money they say you need in your super, all that stuff, it all assumes that your accommodation is taken care of. Importantly as well, government policy kind of assumes that you've got a fully paid off principal place of residence, i.e. excluding that from the age pension assets test. So at some point, property should be a factor for that reason. But property also has some features and some benefits that you don't get in shares. The big one that we flagged before was leverage. The banks allow you to take huge amounts of leverage, borrow huge amounts of money on property that you just can't do in shares. And that does have a wealth building effect.
Yeah.
And then also property allows you to start optimizing your tax position in a way that you can't do with shares.
Yeah.
And that's really where the 1 + 1 = 3 comes in. But we'll get to that. But that's why at some point you should start thinking about property.
And just to break some of that jargon there, Ren, leverage, really what we're saying is, to your point, the bank allows you to buy $1 million house by only putting in, say, $100,000
Well, if you're a first home buyer these days,
True, 5%.
$1 million house in, well, let's say you're in Sydney, or I think Melbourne is just at $1 million with this policy.
Yeah.
You can buy it with a $50,000 deposit.
So you're putting 50 grand in cash and getting $1 million asset. That is a structure that is very hard to replicate in stocks, unfortunately.
Yeah.
Just there's just not the type of products available to do that.
And the reason that leverage can have such a powerful wealth building effect, let's say that $1 million house grows 5%.
Yeah.
So it goes to $1.05 million. But your return on equity, the return on the money that
that
you've
50
put
grand,
in, that
yeah.
$50,000, is 100%.
Yeah.
You've doubled it.
Yeah.
Because you've made $50,000 on the $50,000 you invested.
Yeah.
And that is why generations of Australians have only turned to property.
I know. Damn it. No. So then the question becomes, when should we invest in property if all of those, I guess, good things are on offer?
So there's no perfect answer.
No.
I would say
When you can.
I would say the most important thing is there's no rush. There is this ungodly pressure to get in as soon as possible. And that pressure comes from a few different angles. It comes from our parents a lot of the time because they've done so well in property, because Australian property has been on a 30-year bull run, basically. It comes from the media.
FOMO.
Because there's so much reporting about how much property is going up.
Yeah.
And then it also comes from our peers. I reckon as our friends start buying places, you really feel that I'm getting left behind if I'm
you
not.
feel like you're out of
And so there's pressure from all these different points. And so I think we really want to stress there is no rush, because if you're putting your money to work in any asset class, you're doing well. You're on the right track.
Yes. I would say that particularly in property, when you are putting such a large amount in, you can go wrong if you rush it.
Yeah, because you end up buying a subpar asset.
Exactly.
You buy
Not all property goes up.
You buy a studio apartment in a bad part of town that no one's going to want to buy for a lot more than you bought it for.
Exactly. And you think, I've done the right thing. I'm in the property market, but you've bought shit.
People lose money on property.
100%.
It's not reported much, but people lose money.
A lot of money.
Yeah. When they buy bad assets.
Yeah, because just like you can leverage on the way up, you can leverage a lot on the way down. I.e., you put in 50 grand, but you sell it for a $300,000 loss. That's a loss.
Yeah, that is a loss. That mathematically, that checks out. So I think, there's no perfect answer. There's no rush. Make sure you're buying the right asset, because it is going to be the biggest, most undiversified, most leveraged bet you will ever make.
Yeah.
In terms of like a percentage of your net worth, the first home you buy, it's the biggest financial move you'll make. There's also no right answer to rent vesting or buying a principal place of residence, like the home that you live in. Rent vesting, for people who are unfamiliar, you rent where you want to live and you buy a investment property where you can afford it or where you think the growth prospects are better. But I think, look, there's no right way. It depends on your financial circumstances, but also non-financial considerations as well. Some people like the security of owning their own home.
Yeah.
They love being able to put a nail in the wall and mark their kids'
I know,
heights
I
on
know.
all that stuff.
Yeah.
But either way, yeah, I think answering the question about when, it's like when you have the deposit to get into a good asset, and importantly, when you feel you can comfortably service that mortgage, even if interest rates rise.
Absolutely. Absolutely.
Because that's where people get into trouble as well.
Do your modelling, put an increase in interest rates in, make sure that you're going to be able to service it, because as we've seen in recent history, rates can move incredibly quickly and put you under a lot of pressure if you've taken out a mortgage that is borderline from day one.
Yeah.
We're going to take a quick break, and on the other side, we're going to look at how investing in property and shares can be 1 + 1 = 3. We'll be right back. Welcome back to Get Started Investing, the eternal debate, property versus shares. We're here to say it can be both.
We've got splinters in our ass because we're sitting on the fence.
That's it. We're sitting on the fence. But Ren, you've teed it up a lot through this episode. Property and shares can actually be 1 + 1 = 3. Tell us how.
Well, it's mainly about your tax position.
Yeah.
So I think the beauty of you investing in both property and shares and doing it in a strategic way is that you can minimize the amount of tax you pay. And then you can end up with more money in your portfolio and in your pocket. And in that way, rather than going one or the other, doing both is a 1 + 1 = 3. So how do you do it? Well, the government is very generous to property investors.
I know.
They're generous to all investors, but they have a soft spot for property investors. Maybe because a lot of politicians are property investors.
I would also say just property owners, like the fact that on principal place of residence, it's capital gains free after 12 months.
That's good when you sell.
Yeah.
But in terms of optimizing your tax position year after year, it's not as good.
I don't get capital gains free when I sell any shares that I buy.
I know. I know.
It's unbelievable.
So the policy isn't unique for housing. The policy, the main policy we're talking about here is general for any debt that is used to create an income.
Yeah.
But it's just that for property it is particularly good, which is the interest payments on that debt are tax deductible.
Negatively geared.
Yes.
Yeah.
So if you have an investment property, or if you redraw equity from your primary place of residence, we need a shorter hand for that, your home,
Yes.
the home you live
Your
in.
home, yep.
If you redraw equity from your home and use that money to invest in shares that pay an income, the interest payments are tax deductible.
Yes.
Which is great.
It is great.
And that's how 1 + 1 can equal 3.
Yes. So that gets into the whole debt recycling piece, which we know is a powerful way to actually start doing stocks and property if you do have a principal place of residence. But look, they do play different roles in your portfolio, Ren, as well. Over time, if the tax benefits for property are so in favour.
And the leverage as well. Yeah. Here comes the
government
question.
policy.
Yeah, Bryce is drinking the
all
Kool-Aid.
of that sort of stuff. People are probably thinking, well, why don't I just do what many Australians do and go all in on property? Because it seems like that's the environment is set up for that.
Yeah. So it's a good question. And I think there's a couple of reasons why, and really important reasons why. So first of all is property and shares both play different roles in a well-diversified and well-functioning portfolio. So property, as you said, you get that leverage benefit and you also get a lot of tax optimization benefits. That's undeniable. Shares, you get liquidity and diversification. And so I think people sleep on just how reliant a lot of Australians are on the Australian economy going well, Australian banks going well, and the never-ending government-fueled housing pump continuing for their long-term wealth. And so I think diversifying out of Australia and investing globally is really important. But then the second thing that I think people often sleep on is that you can't eat a house.
No.
And you can't sell half of a house. Like, people are asset rich and cash poor in a lot of ways. And particularly people that, you know, like our parents who maybe bought a place 30 years ago for 4 times their income and are now sitting on an asset that might be, 10 times their income. But if they want to sell part of it to go on a holiday or, whatever, then you're forced to sell the family home or, The liquidity benefit of shares and some other assets, bonds and, gold and crypto, I guess, although that's a different conversation, allows you flexibility in your life that having one really valuable property or a couple of really valuable properties just doesn't give you.
Yeah, it's the classic case of not having all of your eggs in one basket.
Well, that was diversification, but liquidity is also like
You're not going to be able to sell your house like that.
It's like having eggs that you can sell in a basket rather than having a gold-plated basket with no eggs.
Yes. So look, there's plenty of ways that you can make money as an investor, and we're here to say that there's not one right way. There are plenty of different ways. And for us, when we think about property and stocks, and we just think about our own journey as well, it's a matter of sequencing. It's not a matter of picking sides and then sticking with that for the rest of our journey. So think about it from your point of view. If you're early on in your investing journey, you don't have a lot of money, property is probably a little out of reach, but don't let that stop you from getting started in shares for all the reasons that we just said. And then think about sequencing as your life changes and you get, more income and more of a stable foundation, then property certainly has a place to play. And we hope that by the end of your journey and as you reach retirement, you'll have a lovely nest egg with both.
Yeah, and I think the final thing is if you're feeling that pressure, if you're feeling like you're falling behind, you're not. The fact that you're listening to an investing podcast means that you're on the right track, and whatever you're investing in is better than not investing at all. Put your money to work, make it work as hard as you do, and know that over time, as long as you are consistent, you'll be okay.
Love it. Well, if you love listening to this, like and subscribe on YouTube. It does help us get in front of new listeners. But Ren, that's it for this week. We'll pick it up next.
Sounds good.